Hey guys, give me one moment. I'm just going to reach out to Kenny.
Right here.
Oh, hey Kenny. How are you?
I'm good. How are you?
I'm good. No complaints. No complaints.
I was actually just putting together my quick little details of what I was going to cover tonight. And I was like, oh, snap, 7 o'clock. So time kind of came real fast. How's everybody doing this evening? Shaquana, were you going to do anything else or can I just go ahead and jump right in?
You can jump right in. I'm just here.
Okay, perfect. All right. So welcome everybody. So I know the last three classes have been really impactful. Last week, I got into data points, the importance of data points. We've been able to have an opportunity to meet with a few of you guys, which has been awesome, and giving you guys specific action steps in terms of what you need to do. And we still have meetings scheduled to meet with you. Last week, we really got into the weeds about data points, but also I used two case studies. We talked about Wandolin and we also talked about Vinnie Thompson. And Vinny's was unique because Vinny had, he makes a lot of money, but he has this other company that's not in a restricted industry that really is going to be the company he needs to leverage when he wants to go get those lines of credit. Because being that he's a real estate agent and all of his money, for the most part, goes into real estate, if we try to go to like a Chase, Bank of America, any traditional bank, because he's already in a restricted industry, even though he can qualify for 10% of his top line revenue, they're going to decline him. So it makes more sense for him to use his other media company and then make that be his primary company to do funding with. So, and I know with the entrepreneurship boardroom, Shaquana is breaking down exactly how you guys can structure yourselves, set up your holding companies and all that stuff. So that was a real big thing that we talked about last week was data points and also making sure you guys are at a good place, not only from the data point perspective, but you need to know what information to be putting on paper. Tonight's call, I'm going to get into shifting and I'm going to talk a little bit more about when I say shifting debt on your credit report and making sure your credit report is just optimized before you start the funding process. So many of you guys may have used high utilization on your credit cards. So I'm going to break down 4 ways you can get your utilization down. And then going into next week's call, I'm going to get into more product specific. So last week we talked about data points. I even broke down some of the data points about the different products, whether it's business credit cards, business lines of credit, or unsecured term loans. We got into the weeds of understanding debt to income ratio and really figuring out, okay, if I show a little bit more money on paper, how much more funding I can get into. Tonight, we're going to really just take a deep dive into, okay, some of you guys probably have 70 fundability scores, 60 fundability scores. You may have 85 fundability scores, and you either have high utilization or you have a negative item on your credit report. So we're going to get into the weeds of that. Um, and okay, look at we're really in. Okay, so does anybody have any questions about anything I covered from last week? If you do, just put it in the chat. If not, I'm gonna go ahead and just jump right in. And then if Mr. James Chambers is on, James, if you're totally cool with it, man, I want to bring you up and use you as a case study. You don't have to come on camera, but I want to use your profile as one of the case studies I think would be impactful. If you're on. Only if you're on. If you're not on, it's totally fine. I'll use somebody else. I don't think you're on though, James, not yet. So we'll keep it pushing. But does anybody have any questions? All right. I don't think we do have any questions. All right. So what I'm going to do is pull this up. Now, before I do that, I'm going to do a roll call and just make sure everybody's got their fundability dashboard connected. So I think we got everybody to get this done last week, but I'm just going to just make sure we're good to go. Talked about Marjorie, so we're good there. Laverne Collins, are you on tonight?
Yes, I am.
Okay, hey Laverne, I don't know if you had a challenge trying to connect your report, but I noticed that your fundability score is still not connected. Will you run into a challenge trying to connect to
No, just
fundability?
a mainly just a time challenge. So I've got to get to that. But I will. I apologize. I will.
It's okay. So what I'm going to do, Laverne, is since we're on, I'm going to go ahead and just resend you the welcome email because all you need to do
Okay.
is really just follow the process, connect your report, and then you'll be good to go. It'll probably take you 2 minutes to do.
Thank you.
You're welcome. So let me send that right now. So it is sent. So you should have that in your inbox in the next 2 minutes. So if you
Thank
could,
you.
you're welcome. If you could, while we're on, just see if you can get that squared away, go through the onboarding process, and we should be good. Um, is there a Lisa Goodman on? Lisa, are you on? Lisa Goodman, if you're on, I'm going to resend you the welcome email so you can connect your fundability score because it's still not done. So I am sending you the email and all right. Got my fundability score, didn't get a call, couldn't find the Yacon to make an appointment. So I'll walk you guys through how to do that. It's pretty simple. When you're inside the portal, when you're inside the fundability dashboard, in the bottom left or the top right, there'll be something that says book your capital on demand demo session. That's all you need to do is just book that session. You'll be able to find the time. Michelle, will you send that email to me too? Yep, give me 1 second, Michelle. Let me go ahead and knock you out real quick. Get you squared away. Michelle. Um, and Michelle, have you already enrolled or do you have a different name maybe? Because I'm not seeing you in the system.
I have.
Okay, let me see. Bullock. Um, will you send the email to me too? Have you already started the enrollment process, Michelle, for your fundability score?
I haven't.
Okay, so you'll need to do that first.
Yeah,
Do you have the link or do you need us to share it?
I think I need the link again.
Okay, all right. I will make sure we get that over to you.
Thank you.
You're welcome. Fundability score. Is Maureen on?
Most likely she is. Let me check.
If not, I can just go get the link really quickly. I
She's
know
not.
I'll get the link.
Okay.
I'll get the link right now. Command campaign. All right. All right. I'm gonna drop this link in there for you. Um, for you, Michelle. And Linda, I paid $1. I didn't get access. So Linda, if you did the dollar trial, it's on it's a page. It's $1 for the first 7 days and $29.97. But if you haven't, you just want to finish connecting your fundability report. So I'm gonna pull you up real quick, and then I'll get into today's content. So Linda Martinez. So yeah. So it looks like you do have a fundability score here, Linda. So I'll just resend you the welcome email, and then you'll be able to get in there to take a look at your fundability score. It looks like you just need to finish your onboarding. So I'm going to send you the welcome email right now. Resend you the welcome email. All right. All right. All right. And you're welcome. And then Melanie, so Melanie, I know you're probably a little confused. So I had one of my new team members sending out text messages, And at first it was telling you not to book a call, and then it was saying to book a call, but then I ended up texting you and saying, no, you should go ahead and book a call. So Melanie, you're good to go ahead and book a demo call, right? You're good to go.
Okay, so will I be able to use one of the links I received?
Yep. If
I
you just
text
use that link,
messages.
yep, if you just use that link, you'll be able to book.
Okay, because then I did also receive a text message stating that I needed to address my utilization because it was
Yeah.
high. So,
That was,
okay.
I think that was probably me saying that the only thing you needed to address was utilization, and we can walk you through how to do that. And I'm actually going to cover that tonight on the call, actually.
Okay, well, actually, I'm going to have to leave early because I do have an engagement that I need to be at 7:30. So,
Totally fine. Just use that link I text you to book a
okay.
demo, and you either speak with me or one of my team members, and we'll get you squared away.
Okay, perfect. Thank you.
Welcome. All right. So I make sure we got everything.
Excuse me, there are two Melanies on this call. So I also sent a message. I need my score as well.
Okay. Have you already started the process to get your fundability score?
And no, I have not.
Okay. Okay. So I just put that link in the chat. So you'll just want to use that link, and then you'll be able to get it. I need to be able to share my screen, Shaquana. So if you can give me access, thank you so
Just
much.
gave you access.
Perfect. All right. So, here is what we're going to cover tonight. So, one of the big things about fundability is going to be utilization. And utilization is very, very important because if we're able to shift our utilization, now you're going to increase your fundability score. So, I would love to have a volunteer to do this so that way I can show you guys in real time how we can go about getting this knocked out. And let me see who we can leverage. I'm gonna first off just break it down, and then I'll pull up somebody who's comfortable, who already has their fundability score. So, like, the ideal metric you want your utilization to be at is 11% and below. So this means on all three of your credit reports, you want to have your credit utilization by the reporting date at 11% and below. Now, there's a number of different ways you can go about doing this. The first way is you can ask yourself, do I have the cash? Right? If you don't have the cash, which I don't suggest you use your cash, but if you don't have the cash, I don't suggest you use your cash. But if you don't have the cash, you want to start with yes or no. If you don't, now we can go over to, is your debt to income ratio below 37%? If the answer is yes, then what we can do is look at doing what I call a personal loan or consolidation loan. The reason why I say a personal loan or consolidation loan is because typically, anytime we do one of these consolidation loans, and we do these all the time with our clients, typically the minimum monthly payment on the consolidation loan is lower than a minimum monthly payment on the than it is on your credit cards. So for example, we used Vinnie Thompson last week as an example. He actually got approved for actually, I think he used cash. But there was another client that we used that I did this with where we got them approved for enough of a consolidation loan, and their minimum monthly payments was lower than it was on the credit cards. So what you do is you apply for that consolidation loan, and then we look at it. All right, is it lower than your minimum monthly payments? If so, proceed with the loan. If not, it's a business decision. More than likely, it still will be lower. And then now you pay down your credit utilization. What that does is it boosts your score up because credit utilization weighs heavier than installment debt. Now, the thing about installment debt, you typically want to make sure that this doesn't throw up your debt to income ratio. And again, our ideal debt to income ratio is 35% and below. All right. So there's a strategy. One of my favorite strategies when my clients own real estate is have you owned real estate over 3 years with equity? It's either going to be yes or it's going to be no. Okay. So if it's yes, now we take it one step further and we ask, is our debt to income ratio 40% or below? The fundability score will tell us this. If yes, now the question is, do you have a 700 credit score? If yes, you can look at either a HELOC, which stands for a home equity line of credit, or you can look at a cash out refinance, right? Which both of those have two different barriers, but they're both very, very powerful. I'm going to spend a little bit more time after I finish explaining this concept. But in essence, what you're doing is you're leveraging the equity in your real estate so you can consolidate the minimum monthly payments on your actual debt itself. And then now you're at a really, really great place to be able to handle that. Sharon, if you're on, let me know. Just put in the comments if you're on. I think you will be a phenomenal, if you're open, I think you'll be a great case study if you're comfortable with me breaking this down in the front of the class. Just let me know if you're on, if you're cool with that. But now we have, are you at a 700 credit score or not? Now there's this new concept too called an HEI. And this stands for a home equity investment. Now, this is a little bit different than a home equity line of credit or a home equity or cash out refinance. What this does is it allows you to basically purchase or sell your equity to an investor, but there's no minimum monthly payments. So typically with the HEI, if your credit score is below 600, you can potentially do this. If do you have a 600 credit score and above, HEI? If not, then this won't be an option. So really here, a lot of people have dormant equity in real estate and they're paying minimum monthly payments on their credit cards, and they can be tapping into the equity in their real estate to completely wipe away their credit utilization, but then leverage that that equity for another future investment. Not on this class, but probably class 6 or class 7, I'm going to get into deployment strategies, but I'm just kind of sowing the seed that this is another one. Now, the last one, not really the last one, but another one that you can do is, do you have a business, like an actual current business producing 15K or month and monthly cash flow? That's that for the last 4 months to 12 months. So if you already are an existing business owner making sales, already have revenue, you can go do what's called a revenue-based loan, which means they're going to base the loan off of your actual business's cash flow. So if you happen to be that business owner who hasn't filed their taxes or they underfiled their taxes, and you still need to be able to figure out a way to get an infusion of cash to pay down your credit utilization, you can use this as an option. So as long as you have typically like a 600 credit score, yes, you can do either an MCA, which I don't like those, or you can do a revenue-based loan. Basically, all of these options are designed to do one thing and one thing only, and that's designed to pay down your utilization, right? Pay down your utilization. Now, once your utilization has been paid down, now your scores will go up and you're in a better position to access unsecured funding. All right. All right. So I want to make sure I'm answering that question. Okay. So Vinny, I see you just asked a question here, brother. How long does it take to structure your business entities? Also, should it be done through Brooks Alliance? Who does my taxes? How long does it take to fund after your entities are formed? So in terms of structuring your business entity, typically that's a fairly quick process. But with you, Vinny, I know we talked about just like you just using your older entity. So if you get that one reinstated, that shouldn't be too difficult. And then I would just reach out to Brooks Alliance and they can walk you through like the whole tax thing. But if you already have an existing entity, that's typically not too long. Now, in terms of forming a new entity, it just depends on how you're going about doing that. And then you can talk to them and they'll walk you through how long it takes. to get your new entity formed, assuming you're forming a brand new one. Now, Tracy Roberts, doesn't matter if income producing or not. So I want to go back to this question because you asked us about three minutes ago. So were you asking this question, Tracy, based off real estate, or were you asking this question based off revenue producing? Because that way I'll know how to answer this question because I'm just now thinking.
I was talking about real estate.
Okay. So you're asking, does it matter if the property is income producing?
Right.
All right. It depends. If you're looking to do a HELOC or a cash out refinance, the answer is no, because this is going to be based on your personal verifiable income. These three options, no. If you're looking, I would say it depends because it's really gonna depend on what your verifiable taxable income is. So for example, if your verifiable taxable income is enough to cover your mortgage payment and another mortgage payment, then no, it doesn't matter. If
Okay.
your verifiable income is not enough to cover the new debt you're taking on or doing the refinance, then yes, it's gonna need to be income producing.
Okay. Thank you.
You're welcome. All right. So conceptually, guys, these are the 4 ways that we address utilization. All right. These are the 4 ways we address utilization. So give me 1 second. What I'm going to do is see here who we can use as a really good example. So I've got a test client I can pull up. All right. So this is example 1 that I'll use, right? We've got this test user, and outside looking in, we can see that they already have fairly good credit scores, but their fundability score is 70, right? So what we would need to do is find out, what does this person or this user need to do to get the debt to income ratio is low, scores look good, but when you look at the utilization, we can see 42, 27, 37, and then you can see the minimum monthly payment is 437. So when we're looking at just doing a consolidation loan, it would just be as simple as paying cash for $5,500 or just getting a consolidation loan for $5,500. It's a strong chance that a consolidation loan will be lower than 371. You now shifted that debt and it's paid off. Easy peasy, right? That's an easy example to use, right? And that one's super simple. A lot of people overlook this one as an example. Now, the next strategy we can look into is real estate, right? So the first thing is that if you have cash, and let me speak on this. If you have cash and you have the ability to get a debt consolidation loan, I would almost rather you guys don't use your cash and you use the bank's money to pay down your utilization. And the reason why is because if you have cash that's sitting, there's this thing called fractional reserve banking. And really what this means is that when you start a relationship off with a bank and you start that relationship off opening up a business checking account, it's better to take the cash that you just have sitting in savings on the personal side and then use that to establish a new business banking relationship, because now you're going to put yourself in position to get something called a low 5 bank rating. And I'll pull this up and I'll explain to you guys exactly what I mean by this. So where are we at here? All right, so credit limit accelerator. All right, boom, break this down here. And it's going to be right here in this system, right here. Give me 1 second, guys. I'm pulling this up for you. Uh-oh. 05 bank rating, where'd you go? I'll show you guys a visual. And then I'll get into one of my spreadsheets and show you guys this. So while I'm pulling that up, if you have cash to pay off utilization versus leveraging a consolidation loan, it becomes a decision of what's your minimum monthly payment going to be? And if you're going to use your cash, it might make more sense just to use the cash to open up a new deposit relationship. So this right here kind of gives us a visual. So if we're at this place and we're using that test user, right? If I have cash, right, I can easily pay down my utilization with cash. Or what you could do instead, if you have a business entity but not a business checking account formed, what you can do is take that cash instead. And if this is assuming you just have cash sitting in savings, and you can deposit it into a new business checking account first. Now, many people don't know that when we're looking at opening up your business checking account, fractional reserve banking means whatever you put in the business checking account, that bank can legally loan out 9 times that number. So, for example, if you have $5,000 cash and you're opening up a new business checking account, instead of using that $5,000 or $5,500 cash to pay down your utilization, redirect that $5,000 to open up that new business checking account, because now what will happen is you're going to put yourself in position to where your bank rating is going to be rated based on that amount of the deposit. So the ideal bank rating is something called a low 5 bank rating, which means your account balance is between 10,000 to 39,000. And I'll break all of this down in terms of like, how do we get this? But if you just have cash, it's probably better to open up that business checking account, put $10,000 in that business checking account if you have the ability, however much you can put in there. Because now what's going to happen is your account is going to be looked as though you're less risky. But also when we look at fractional reserve banking, the bank now can loan out more money in their network based on the deposits you put into your checking account. Now, it doesn't mean that they'll loan you 9 times the money, but if you start a relationship off with a bank and you put $5,000 in that business checking account, you have a fundability profile, you have everything that looks good, it's going to increase the chances that you're going to get approved for a higher limit. So that's why I'm saying that if you have cash, I'd rather you not use the cash. And if you're choosing, if you have cash to pay down utilization and still open up a business checking account, then do that. But if you have cash and you still need to pay down utilization, it would actually help you just to get the consolidation loan and then deposit that cash in the new business checking account. All right. So just wanted to kind of clarify that. Now, let's get into real estate equity. All right. Because this one can get a little fun. And I've got this spreadsheet here to figure out how do we look into accessing equity in our property. Now, there's 2 spreadsheets I'm going to really get into here, but by a show of hands, or just put one in the chat, how many of you guys own real estate and you have equity, but you feel like you're not leveraging the equity strategically? How many people own real estate, but they feel like they're not leveraging the real estate equity strategically? All right, there's a couple of people in here. Okay. All right. So I'm going to give you guys it's a lot of you guys. Okay. So I'm going to give you guys some food for thought. All right. So I think I have another
all
test.
this, I have to like,
Somebody
sometimes all this pizza, I have to like walk on the treadmill all night long.
Hey, whoever's speaking, can you mind muting yourself? All right, perfect. So let's anybody who just said me, have you already completed your fundability score? With the exception of with the exception of Vinny. Anybody who put a 1 in the chat, have you completed your fundability score? Because I want to use you as a real live example if you're okay with it. I might just have to use Vinny. I see Vanita, Wilton, Andrea, Valita. I think Valtia, I think you have a call schedule coming up. Angeline. So there's a couple of you. Are
Monday
any
at
of
3.
you guys okay with me using you as a case study? Anybody? Brian? All right. So Erica Brooks. All right. So I'm going to bring up Mr. Murray. I'm going to use him as an example, right? So let me pull up his deal. Now, he's not going to have much credit utilization from what I recall, but I'm still going to use him as an example, right? Oh yeah, Wilton, you would be a good example. You would actually be a phenomenal example. Actually, Wilton, if you're okay with it, man, I think we got to follow a call anyway. So I would like to use you as an example. And then we can go over to Mr. Murray too. So I'm going to do Murray first. He actually wouldn't be the best because his utilization isn't too high. And then we're going to use this calculator here. Yeah, let's use Wilton. All right, Wilton. Because I think we did some really good detailed stuff with Wilton already. Yep. All right, so I'm going to pull up Mr. Wilton. So he's a phenomenal example, right? So I want to show you guys this, and then we're going to use this spreadsheet to kind of reverse engineer this and conceptually help you guys understand if you're leveraging equity to pay down credit utilization, why this is such a powerful strategy. Because a lot of people get so caught up on the interest rate, not realizing that you have to think about the cash flow of the transaction. So anytime we're shifting and we have equity, we first want to start with what are my minimum monthly payments that I'm paying on all of my credit cards. So right now I can see his minimum monthly payments is $1,570. Now he got some pretty impressive amounts of credit. He's got $225,000 worth of available credit. He's only using 21%. But from a fundability perspective, we really want our utilization to be at 11% and below. So going back to this chart, we want to reduce utilization below 11% before we go to the bank. So although Wilton has great credit scores, we don't want to give the bank any reason to say no. So, all right, what do we do? Well, the number that he would need to come up with is $30,000, right? And the minimum monthly payments, we can all agree on the $30,000 is $1,297, right? So I'm not gonna break down every line item with the credit card because that'd be too much. I'm just gonna say right now the balance right now is $30,000. Okay, and then the existing payments on that $30,000 is $1,297. All right. If you guys are tracking with me, let me know. Right. So minimum monthly payment is $1,297, $30,000 right there. All right. Now, Mr. Wilson, just give me a ballpark range of like one of your properties, like the estimated value of the property. I don't need the full amount. I just need an estimated value so I can show everybody how this works.
It is 456,000 is one of the
Okay.
estimated value.
All right. And is that recent?
Yes, I looked it up on so it's between 403, 400 and about 479. And the middle
Okay.
was 450 something.
All right, we'll just use 456 for the sake of this example. All right. And is it one of these, is it one of these mortgages right here? This
Yeah,
Navy?
the Navy Federal one.
Okay, perfect. So we're gonna do Navy Federal right there. All right, and we're gonna say that the amount that is negative right here, 293. All right. So anytime you're doing, guys, so first off, there's this thing called LTV, which stands for loan to value. So the loan to value is based on the appraised value of your current property, which is why I just asked Mr. Wilson, what is his projected value? Ultimately, the appraisal he gets is going to determine the value. Having said that, if you have verifiable taxable income, depending upon the lender that you choose to do this with, you can do either a first lien or a second lien HELOC. But conceptually, let's just say we're going to get cash out anyways. So currently, let me move this over. Prior to this happening, right now, Mr. Wilson is paying $12.97 a month on these minimum. He's doing this now. If he gets a loan to value of 90%, that means his new line amount on his real estate will be $406,000. That also means that it would take into account his already existing balance, and then assuming he doesn't have any other HELOCs or anything like that on his balance, that would mean he would get cash out of $111,000 conceptually. If he has an 80% loan to value because that lender gives him 80%, then that means that the difference between the max line, which is the loan to value, and the refinance debt gives him a number of 70. If he gets 70,000. If he gets a 70% loan to value, which typically 70% loan to value is if you have lower credit scores or if it's an investment property, if it's not a primary residence, then it's going to be 319,000. So the only cash out would be 24,000. That wouldn't be a good transaction to do. So it's a strong chance, those of you who are leveraging equity for your primary residence, you're going to be 80% or higher. All right. So to recap, before I take it one step further, right now, if the property value is 456, that means I can get a new line of credit of 364, which means it's going to be the difference between how much I get and then how much I owe. That's how much cash out I would have available. If that made sense so far, guys, let me know. Put a 1 in the chat. If you guys are following what I'm saying, put a 1 in the chat before I take it one step further. All right, now let me push it. See, a lot of banks don't realize, a lot of consumers don't realize that when you are getting cash, the bank wins by you having your banking going, a business checking account, a personal checking account, a mortgage, having them all separate. Right? So let me push this and show you how this is very, very powerful. So I've got this other calculator here, and I'm going to show you guys how powerful like the interest only works. Oops, not this one. It's going to be real estate HELOC. Oops, not that one. I always do this. It's going to be, oh, not that one. I believe it's this one. If I keep doing the same, where is it at? Oh, it's not that one. I probably have it in another place. Real estate, HELOC calculator, DTI calculator. Here we go. All right. So now we can all agree if he gets an 80% loan to value, his max line is 364. So a lot of people get caught up on the interest rate, not thinking about the effective rate of the capital that you're getting. So if he gets a new line at 364, we have to look at the cash flow, but more specifically, what's the new monthly payment going to be on that, assuming he had a higher interest rate and it's interest only on the first lien HELOC? Well, His new minimum monthly payment would be $2,300. Anything he puts past the $2,300 becomes profit. Now let's go back. Right now, he's currently paying $1,297 a month for the credit cards right now. Let's go also back. He's currently paying $1,671 right now. So if we just add those in this example, 1671 plus the 1570, that's $3,200. That's what Wilton is currently paying. You guys are already kind of seeing it. It's lower. So simply, and this is assuming he does the full line. We only need to get 30K. He doesn't need to get the full 70, right? He really only needs 30. So assuming Wilton chooses to do, let's just say, a first lien HELOC, which means now he's taking the debt, he would consolidate this completely, plus get some additional cash from the difference between this, and this new line is 364. He now has an additional $1,000 on a monthly basis that he can put towards paying his principal. Does that make sense what I just shared, guys? What I'm getting too deep here? Because a lot of people look at their money in silos, but they're not realizing that, hey, mortgage companies win when you do the mortgage, because there's a difference between interest only and amortization. I know we're talking about funding, but I'm talking about funding right now and how to increase your fundability. But what I'm really helping you guys start to see is that when you look at a mortgage, it's amortized over 30 years. So typically a mortgage, a traditional mortgage, but I'm not bashing traditional mortgages. Typically a traditional mortgage is going to be front-loaded interest heavy. So if you look at your principal and interest payments, you'll notice that if you're paying $1,500, maybe $900 is interest and $600 going towards principal. Versus if you're leveraging and you're getting the equity out of your house and you're using that to consolidate debt, instead of all of these minimum monthly payments going to the credit card companies, you completely wipe that clean. And now what happens is you turn your house into your bank. So now that extra $1,000 that he has and that he's getting, he can now put that towards paying down his principal. But the powerful thing about a HELOC, if you're leveraging this as a way to consolidate your debt, is anything that you put towards, any additional amount that you put towards principal, it reduces your actual principal balance, which means it reduces your interest only payment, which means you pay your mortgage off faster, or you pay your real estate balances off faster. Now let me push this, because most people, when they're looking at the HELOC, they'll get intimidated because they're saying, I'm paying 7.75% on this rate, not realizing that if you're putting that additional cash flow towards your principal, you now actually are gaining equity. And guess what? Anytime Wilton or any of you guys want to go pull your equity out, you don't got to ask permission. You literally shift the money from your HELOC to your checking account and you go make that investment. So I'm not saying a first lien HELOC is for everybody, right? Because I went from how do you get equity out, and then I kind of shifted to showing you guys the numbers so you can understand that if you are going to leverage the equity and you have the ability to get a HELOC, this is how much cash you can get additional. But then it just becomes a business decision. Is the minimum monthly payments going to be higher than the minimum monthly payments I'm currently paying on my credit card? 95% of the time, the minimum monthly payments on you accessing the equity is lower, which means you immediately make more cash flow, which means if you're financially disciplined, you can reinvest that cash flow towards either paying down the debt or putting it to another opportunity. Does that make sense, guys, what I just shared? You guys with me? You guys with me? Because a lot of people A lot of people don't get this information. So when they're looking at, okay, well, man, I didn't know I can do this. And we're looking at, okay, fundability, and we're looking at, before we even get to the point of getting business capital, let's just figure out how we can maximize this here, right? Let's just maximize how do we maximize this? Because ultimately, we're getting funding not to go into debt. We're getting funding and we're being strategic with our money so that we can accelerate our ability to create more wealth by way of saving money and interest, but also by deploying said capital towards some type of cash flow producing asset. That being said, and we go back over to why I'm like, okay, if you have a 700 credit score, you can do a HELOC, right? But a HELOC's typically only available for primary residences, right? Sometimes, let me be clear, there are lenders that will allow you to do one of these HELOCs on a secondary residence, and in some cases, an investment property. So if you own a secondary residence, or if you own an investment property, this is why we show on the calculator the 70% loan to value, because there are lenders that will allow you to do the cash out refinance, but the juice has to be worth the squeeze, which means we have to make sure we have enough loan to value if we have a current balance on that property to be able to get the cash out to make the transaction work. But even if that works, the question you should be asking yourself from an order of operations perspective is, do I have high interest rate debt right now on credit cards? Yes or no? If so, it probably makes sense to stop paying those credit card companies, consolidate that, and then put it in your own equity bank or your own HELOC, right? If you don't have high interest debt and you just have money available in your HELOC, now we want to be looking at, okay, well, what else can I do to accelerate my position to create more cash? Can I buy another real estate property? Can I start a business? Can I take that money and do an investment? Ask yourself that question, but what we're really going to be looking at is, how do we consolidate? So we go back over here and we're looking at like a cash out refinance, right? The only difference between the cash out refinance and the HELOC is you're getting the cash out and now you have another 10 to 30 years to pay that off. So a cash out refinance works just like a traditional mortgage. Generally speaking, you're getting the money up front. You have a fixed monthly payment. That's not going to allow you to really leverage that much because you're getting the money up front and you just have 30 years or whatever the time is to pay it off. So that's still a viable option, especially if you know that I'm getting this cash out and I'm going to go buy another property, then that makes sense. I was speaking with a client recently, and in some cases, I wouldn't say a cash out refinance is a leverage play to do when you're attempting to pay down debt. You can do it if the minimum monthly payments on the cash out refinance is lower than the credit cards and the debt consolidation. It does make sense to do that. However, typically, a cash out refinance is really done when you put cash into a deal, your own cash. You're looking to refinance at a higher value so you can get your cash back out of the deal. That's generally how I suggest people do cash out refinances. Because think about it. If you're doing a cash out refinance, and that cash out refinance you're using to consolidate debt, and you have freed up cash flow, if you put additional cash flow towards an actual mortgage, you will absolutely pay your mortgage off faster. But here's the challenge. If you want to access the equity again in your second mortgage, guess what you got to do again? You got to go do another refinance again. You got to go through the whole process again, versus with the HELOC or the home equity line of credit. Once you have that home equity line of credit, typically there's a term where you can draw on it. You don't got to go ask for permission. You don't got to ask those guys, can I use my own money? So it's just a really powerful strategy. So Wilton, thank you for allowing me to use you as an example, because you were like the perfect example on how we can do to make that happen. Because what you would do if you were to go down that road is just really just what we just shared. And it puts you in a good position. I know we're talking about utilization, but that's just how we want to be thinking about this. You can pay down on a HELOC. You can absolutely pay down on a HELOC. So for example, I'll just share this with you. So let's just say, and I'll just wrap this up. Wilton did a HELOC at 365. It's a first lien HELOC. His interest only payment is lower. And let's just say that, you know, his net monthly income is, his gross monthly, well, his net monthly income is 15,000. His expenses is, you know, we'll call it, you know, 7,000 a month. And now he's got freed up cash flow of $8,000, right? In this example, if he has free cash flow, and this is kind of like what I was talking about when the bank kind of wins versus you win. See, what the bank wants you to do is have a mortgage, have a car loan, have a credit card, have all these monies be separate, because they know that, one, the more money you put in their account, I want to go high level here. The more money you've deposited in their account, the more money they can loan out and give you no interest. That's banking 101, right? So when we look at, can we pay down towards a HELOC? Let me answer this question. But yes, you can. So if it's a first lien HELOC in this example, if you have 15,000 a month and you have 7,000 expenses, that means you free up $8,000. So there's two choices here. Choice one is you can have that $8,000 just go towards a checking or savings account or an investment account. Or choice two is you can put the additional principal or the additional cash towards paying down your principal. Now, why would one do that? Well, you would do that because in this example, you would pay off your actual mortgage balance in 4.5 years. Now, one would say, well, why would I do that? Well, think about it. All of you guys can do this. Look at your property that you purchased. If you has anybody owned a property in here longer than 10 years? Put a 1 in the chat if you own a property longer than 10 years. Okay. Has your property value gone up or gone down over the last 10 years? All right. All of you who are putting up, I want you to specifically tell me in the chat, for everybody listening, how much did your property value go up in the last 10 years? Put it in the chat. $10,000, $400K. Oh, shit. I'm sorry for cussing. 400,000. Wow. Okay. So let's use these numbers. Let me show you these numbers so that way I can really drive this home, because I know we're talking about funding, but we're also talking about wealth, and I'm talking about shifting. I'm bringing it all even circle. I'm going to use Glenda. Glenda said that her property went up $170,000 in the last 10 years. So we can assume that means her property value increased $17,000 every single year for the last 10 years. That's what happened. They're not making any more real estate. And they're going to keep doing inflation, so the dollar's going to keep going down, which means the value of the real estate is going to keep going up. So the question is, to bring this back, if you have $8,000 a month free cash flow, where can you invest $8,000 a month? And we'll say $8,000 a month. 8 times 12 is 96, but we'll just say 100,000. Has anybody got a guaranteed $17,000 on their $100,000 for sure in the last 10 years? I'll wait. Anybody? No. I'm using Glenda to drive the result home that she got 17,000. Natalie, you got $40,000 on your 100K in the last 10 years for sure. Janine, 60K on your 100K in the last 10 years. So what's the point? The point is that with the exception of Natalie, who said yes, taking that freed up cash and paying down your principal balance on your real estate because the underlying asset itself is appreciating is a good financial decision. But then you can always access that equity whenever you want to go do what I like to call leverage or double dip. So that's really the point I was making. So any freed up cash, when you're paying down your HELOC, what that does to drive the point home is if the interest only payment is $2,300 month one, and you're taking the additional money and you're reducing your principal balance, now after 14 months, your interest only payment went from $2,300 down to $1,800. So in essence, because your interest only payment is based on the principal balance, there's no, and this is the difference, this is the stark difference between this and a mortgage. Because you can put more money towards principal, that means you can drive the principal amount down, which means you lower your minimum monthly payment, which means you accelerate how much equity you access, which means anytime you want to access to do whatever you want to do, you can do. All right. So I'm going to get off of this because I think I've preached about this enough. The reality is this isn't going to be a good fit for everybody, but those of you who have dormant equity, this is a really powerful strategy to go back and do the very first strategy, which is let's just reduce our credit card utilization. But at the same time, if I want to reduce my credit card utilization, I want to put myself in a position to where I can become the bank with my real estate, right? And if I thought interest only was not a wise investment, that's a great statement. And from a conceptual wisdom perspective, it's not. If you're only paying the interest. If you're taking your additional principal and putting it towards paying down the balance, it's a no-brainer investment. Because when you look at amortization versus interest only, amortization, you're paying interest over the term of the loan, versus interest only, you're only paying interest on the balance. So if your interest only balance is significantly going down on a monthly basis, that means the amount that you're paying is actually lower. Mortgage companies don't really promote first lien or even second lien HELOCs because if they did, they would make all the interest, right? They're not incentivized to sell these. Loan officers aren't selling these things because they don't get paid those 3% and 10% commissions. They're getting a couple $100. So this tool is actually a little bit better for the consumer when you're educated about how cash flow works, which is why I was saying, instead of having your money work in silos, you would have your money just going towards this, right? So, but that's equity, right? This one right here is probably one that a lot of people overlook and they don't understand how powerful it is. But when you start to look at your specific numbers, which is why I use Wilton, you start to kind of look at your stuff differently. When I first saw this, I was like, I didn't get it. But then when I got it, I got it. So now, once you start to see that, oh man, the banks are in business to make money, but the banks are not my enemies. I'm just uneducated about what the tools are that are available to me. Now let me start to use those tools for my benefit. So when we look at increasing fundability and increasing cash flow, this is a simple way to do it, right? Leverage your equity strategically. And then all of my business owners who do not own real estate and you have a business already producing cash flow, what you can do is just leverage a revenue-based loan. Right. And I already talked about this, but this really means your business is producing cash flow. You're getting that money up front and you're borrowing the future value of your cash flow to pay down your credit utilization so that why? our fundability score goes up, and now we're in position to get more funding. So let me drive this home since we were using Wilton as the example. Well, once Wilton chooses to do that, now Wilton has himself in position to go ahead and get 100,000 to 288,000 on the low end on one type of the leverage pathway. He also has the ability to go get another, we're just gonna be conservative and just say 100,000 to 288,000 in funding, right? Just being very, very conservative for him. So the question now becomes, and I'll go in our next call, I'm gonna get into products, specifically funding products. Tonight I got into more of a consumer product, which was personal loans and HELOCs, and then cash out refinances. But the question now becomes, he would free up more cash flow. He's got about $1,100 a month he's saving. And now that puts him in position to get 100,000 to 288,000 in actual business funding that does not report to his personal credit. So funding is not income. Funding is just a way to accelerate how you invest. So we start to look at this calculator here, right? And we start to figure out, okay, how much money am I going to save? And then what are my opportunities going to be, right? Meaning, do I want to go out and I'm going to save this calculator for class 7 and class 8, but I'm going to sow the seed now. Do I go out, get 100K, 200K, 300K in unsecured capital, typically at lower interest rates? And do I go out and purchase something that's already producing cash, like do a business acquisition? Or do I go out and now look at real estate, right? Do I use some of my money as a down payment and I go into multifamily and start to figure out what's the cap rate, what's my cash flow going to be, right? Because what we're doing really is we're looking at the number one thing that matters anytime we do this entire process on the business side. So to drive this home for Wilson, he gets 100 to 288,000. He then leverages, he's already saving money on his interest. He's already accelerating paying down his mortgage, his number one asset. We all agree that real estate has gone up over the last 10 years. So let's secure our asset first, right? Lower the utilization. But then we start to look at, okay, if I'm going to invest my money in buying something that's already producing cash flow, the number one thing I really care about is my cash on cash return. I'm not going to make this class about this, but I'm just future pacing you guys to see where I'm going with this. What's my cash on cash return going to be? If I'm going to go do real estate, what's my cash on cash return going to be? Right? What's my cash on cash return going to be? What is that going to be? What's my appreciation going to be? Right? So that's all I have tonight. I really wanted to break down everybody who has utilization over 11%. We can help you with one of 4 of these strategies, right? We can help you consolidate your debt, create more cash flow, increase your fundability. The HELOC is not going to be for everybody. Real estate equity is not going to be for everybody. Revenue-based loan is not going to be for everybody. Personal loan is not going to be for everybody. Your situation is specific. So your fundability score is going to tell us where you are and what you need to do. And then you just take that strategy for your situation. All right. And we'll help you do it. And that's pretty much it. So I'm going to go to the chat, see if there's any other questions here. I'm on this strategy to lower my credit utilization. Just need this negative account that I don't owe to be removed off my credit report. All right. So there's a number of different ways that you can go about doing this. I won't make this about credit repair. We do have a really, really powerful AI strategy that you can leverage to get that negative item removed from your credit report, but you do want it gone. Because once you got that thing gone, now you're going to increase your fundability and you'll be good to go. We're at the hour. I can open it up for more questions, but that's all I got, guys. Hopefully this was helpful for you. Inquiries are easy to get done. You can typically get inquiries removed in 24 to 72 hours. There's like a whole strategy that you can go about doing that. We send it to our clients all the time. All right, so there's questions. All right, perfect. So let's shift over. So, Linda, you were first. So how can I help? What's going on? Linda, you're muted. So I don't know if I need to unmute you, if you need to unmute yourself. Hey, EP, I'm wrapping up this class with Miss Brooks, but can you make sure that Wandalyn gets the inquiry removal process? Could you send it over to her? Linda, I'm not really sure how to unmute you, but I can't hear you. If you just put your question in the chat, I can answer it there.
Okay, I'm unmuted.
Perfect. What's going on?
Took me a while. No, I had asked about, you said you were gonna send me the welcome email again, so I didn't get it. So I'm wondering if, trying to just double checking if you got the right email address.
Yeah, let me pull that up real quick.
Cause that could, I have two email addresses. And it's possible that I might have typed in the wrong one. I don't, but I looked in the same.
Okay. 1 second, Linda. All right. So Linda Martinez, right?
Mm-hmm.
All right. I sent it to a Gmail account.
Okay.
Linda
Linda C?
Martinez, Linda C Martinez 713@gmail.com.
Okay. So I'm looking for it, but I don't find it.
So here's what you can do instead.
Okay.
I'm gonna put this link in the chat for you. Just
Okay.
go to My Money. Am I still sharing my screen? I think I am. Yeah. So just go over to mymoneyedu.com. Click on sign in. It's going to take me directly because I'm already logged in, but you would just go to mymoneyedu.com, click on sign in, and then just enter that email in. And then you'll I'm gonna do an incognito window. So you would just go to mymoneyedu.com, enter in your email, and then you'll get a 6-digit code sent over to you. And then as soon as you get that, you'll be good to go. Matter of fact, what I'm gonna do is I'm gonna do it right now. I'm just gonna do it for you. So you'll probably get a 6-digit code. You don't have to give me the 6-digit code, but let me,
Okay.
did you get a 6-digit code?
Negative.
Okay. So,
Oh, no, I got it. I just got it.
all right, perfect. Don't give it to me. Don't give it to me. All right. So,
Okay, so we know it works.
correct. So just go to mymoneyedu.com, click on sign in. Then when you do that, put your email in, you'll get the 6-digit code, and then you'll be able to log in.
Okay. And then, so just a point of then I'll be able to see my report.
Yep. And then I think there's a couple of things you still need to finalize with your onboarding, which is super simple. Just finish answering the questions. And then
Okay.
once you're done with those questions, you'll be able to see your fundability score in your report.
Okay. Okay. Thank you.
Welcome. All right. I think Natasha, you were next.
Yes, hello, can you hear me?
Yes, ma'am, I can. How can I help?
Okay, good. I think I missed the last class that I believe that you were on, so and I'm gonna go back and look, but I'm just wanting to make sure, the first thing I need to do is do this fundability score, and see where that lands me, and then
Yeah.
get a call with you
Yep.
to determine what next steps are.
Yes, ma'am, you got it.
Okay, okay, good. And then my other question is in regards to the low five bank. So once you move like your personal cash over to the business checking account, so do you have to like maintain this amount in that account, or is
Yeah.
that not a factor?
Yeah, you will want to maintain it ideally 60 to 90 days.
Okay, from when you first started.
Yeah.
Okay.
Yep. So if you have cash deposited in there, let it stay in there 60 to 90 days. So if you did a HELOC or you got money, cash deposited in there, so that way it can go through three cycles. And then there's this thing called the Small Business Financial Exchange. So now your information is going to start getting passed through that exchange, and other banks are going to say, "Oh, okay, Natasha, she got bread over there. What she got? What she got going on?" Now you're going to increase their visibility as well. Increase your visibility to them.
Okay. And then pretty much, after you've maintained that balance, it can fluctuate from that point forward.
Yep.
Okay. Okay, thank you.
You're welcome. Good question. All right. Lisa, what is going on? I believe you are next.
Hi, Kenny. Yeah, I'm playing catch up here. So this is my first call, and
Okay.
I'm not quite sure where to start. Do I need to wait for a welcome email? Do I do the fundability thing?
That's a good question. So, Shaquana, were the calls recorded? My previous calls, were they
Yes, the
recorded?
calls were recorded and they are all in the portal. So Lisa
Okay.
did just join. So I think she would just start with that link. And
Okay.
then when she starts with the link, she should be able to get started there.
Okay.
Okay,
Mhm.
Okay,
perfect.
perfect.
Okay. I would also be interested in the getting rid of the inquiries. If you have
Okay.
that available, that would be great.
Yeah. So I
All
would
right.
say step one, get your fundability. We'll see what the inquiries are, and then we can get you out the information on how to get the inquiries removed. It's
Awesome.
super
Awesome.
simple.
Thank you.
You're welcome. All right. Val,
Amy, can I just interrupt you just for 1 minute? I just need to make an announcement really quick,
go
because I
ahead.
know people will start hopping off. Guys, I am going to give you all information about Toast to the Vision next week. If I can get the link and everything from the if I can get the link from the hotel prior to that, we'll send it out. However, I do need to just know if you are interested or if you are not interested in attending the international event in January. So it is January 30th through November 2nd, and it will be held in Mexico. So I need to know if you all are going to attend, if you're interested or if you're not. Please click the link that Maureen just put in the chat. And please just let me know if you're interested or if you're not. You guys know I track every single thing. So I need a response from every single person. Kenny said, I'm interested in attending. Listen, Kenny, make sure you sign up. Let us know. Kenny needs to be there, right? So we're going to figure out a workshop for Kenny. Kenny, January 30th through February 2nd. So, guys, please make sure that you complete it. Even if you're like, I am not coming, I am not interested, just please let me know if you are interested, if you intend on bringing someone. We need to know, right? Because we need to be able to say to you, okay, obviously you guys have to book your hotel, you have to book your flight, but everything while all activities, everything that's there is included. But if you decide to bring a guest, we'll have to let you know, okay, well, this will be the price for the guest. Please just let me know if you when you guys don't respond, it makes my job harder, right? And I want to make sure that we can fully accommodate you guys and your guests. So please just click that link. So there is a link. I see some of you guys saying that you are Raquel, don't Raquel, don't respond again. And that's if you guys have already completed the form. If you guys have already completed the form, then you don't have to do it again. This is just for those of you who have not completed the form at all, letting me know if you are interested or if you're not interested, right? I just need you to just click that link and just let me know. It doesn't commit you to anything. If you say, yes, I'm interested, but then you say no, or even if you say no right now, and then, down the line you get FOMO and you're like, I want to attend, it's totally okay, but at least it gives me a ballpark in terms of where you guys are. Okay. So please, it's okay, Nicole. And I apologize. The message you sent me, I actually just sent it to John. I forgot to send it to him last night, so I just sent it to him. So you can expect a response tomorrow. Mika and Gail, I responded to your messages as well. But guys, Maureen, if you could just put the link again in the chat. Guys, please click the link. I do see people responding in the chat just saying that they are interested. There is a link, there's a form that I need you to complete. So just take a moment and click the link and complete the form. All right. Well, we have Kenney joining us, so excited about that. All right. So that's all I wanted to just hop in with that. And then so I'm still here, but I'm going back on mute.
Yeah, I just signed up, guys. So I mean, y'all going, I'll be there. You said January 2nd through February 2nd? January 30th through February 2nd?
January 30th through February 2nd, yes.
There. Just let me know. I'll be there. All right. Valita, hopefully I'm Valtia. Valita.
Valicia, I'm trying to get back on. Hold on a second. Where am I? I am, Kenny, I think I'm trying to fill out the form and I lost you.
Okay. I can
But
still
anyway,
hear you.
tomorrow, no, next week, I know I'm gonna miss your class, the Miss Business class, so it will be recorded and I can look at it.
Yes, ma'am. I believe
Yes,
so.
it will be, and it'll be uploaded in the portal. I mean, in the community.
Okay, and I have an appointment with you on Monday anyway, so I'll save my other questions for then. Thank you so much.
Okay, perfect. All right,
Okay,
I think that was the last question. So I don't really have anything else. Next week, I'm going to get into more specifics about products on the business side.
okay,
Probably break down some bank research, but really just get into products and specifics since we talked about optimization tonight in great detail. All right, I'll do a recap of this class, but that'll be next week. But other than that, I'm going to give you guys 52 more minutes. And those of you who have already booked fundability calls, I'm happy to help. And those of you who are already in our pipeline will be in contact with you and be able to be a resource. But we'll chat soon.
thanks so much.
Thanks, Shaquana. I am out.
Peace.
All right, Kenny, thank you so much. I will see you here next week. Are we
Yep.
here back here again? Okay, yes. I will see you here next week.
All right, chat soon.